This video is for educational purposes only, not investment advice. It is not an offer or solicitation to buy or sell any security. Investing involves risk. You can lose money. Do your own research and consult a licensed professional before acting. I may hold positions in companies discussed, but will not make trades within 72 hours after publication. Positions may change without notice. Paid promotions or affiliate links may appear. Details will be in the description. Opinions are my own. Data are believed reliable but not guaranteed. CFA and Chartered Financial Analyst are trademarks of CFA Institute. See video description for full disclosure. In today's video, we're going to do an update on my coffee can portfolios, and sadly, a couple of them will be going away soon to pay for a minivan that my wife and I are considering buying for our family of four kids plus us, so 6 total. So let's start with the dividend stock draft, which is the first coffee can portfolio that I started back in 2020. The original portfolio value was $1,000, and I bought 32 stocks after the 32 NFL teams, hence the idea of a NFL draft. So what I did was I bought the highest 32 shareholder yielding stocks in Vanguard's Dividend Appreciation ETF, or VIG. Those purchases were made on April 22nd, 2020, and I did those over at M1 Finance. And since then, I have had 0 transactions, but I have had dividend reinvestment turned on. Here are the stocks in that portfolio. And these are sorted by highest unrealized gain to lowest. So you can see there are 3 stocks here that have actually lost money over the course of basically a 5-year period where the market has done almost nothing but goes straight up. So these are very big underperformers, as are a lot of these. You can see there's a lot of just kind of mediocre to poor performing stocks, particularly relative to the S&P 500 and even the VIG index over this time period. But even with those very poor performers, this portfolio has actually outperformed VIG, going up a total of 118.4%, compared with VIG up 105%. And both of these are dividends reinvested, total return. So as a whole, I would say this has been a success to outperform the benchmark by about 13% over this time period, literally taking 0 action. This portfolio has also been a little bit less volatile with less downside. As you can see, this white line, which is the portfolio, did go down a little bit less in 2022, and then also less here in this most recent correction because of the tariffs. So it's been a better performer with less overall volatility. So overall, I've been pretty happy with how this one is done. This will sadly be one of the portfolios that will be gone after I sell it, put it into the minivan. So thank you very much, Dividend Stock Draft. You've contributed greatly to our family. Thank you so much. The second portfolio, which will also be going towards the minivan fund, was the Valuation Derby portfolios. This was $1,000, and I invested that across 5 different portfolios of 30 stocks each. And all that was done on April 3rd, 2020. The only transaction I made in these portfolios since, in 2023, at the end of the year, I did tax loss harvest some of the losing positions to try to offset some taxable income that I had in that year. But otherwise, there have been no transactions, no sales made. I have reinvested the dividends, and these portfolios were decided based on valuation metrics. So I had predicted, basically the point of this video in the first place was that I thought shareholder yield was going to be better than dividend yield as far as predicting future performance, which turns out to be accurate. I will show you the results here in a minute. But there are also some other valuation metrics that we use. So EBIT to EV yield, forward earnings based on analyst estimates divided by price. So kind of an earnings yield. And then the Buffett yield, which is basically free cash flow over the last 5 years divided by enterprise value. So $1,000 in each one of those portfolios, and here is how they performed over time. The best performing overall was the shareholder yield portfolio, which is what I predicted. It did significantly outperform investing based on dividend yield. Second place was EBIT to EV, and then we had forward earnings followed by Buffett yield, which I was kind of surprised this metric didn't perform better than it did. But anyways, one last thing to mention, these were all weighted relative to the S&P 500 sectors. So at the time, 8 stocks at a 3% weighting each, or 3.3% weighting each, equaled the S&P 500's weighting in technology. So here's how these portfolios compared to both the S&P 500, had I just bought the S&P, and the S&P 500 Value Fund. Now this is what I've considered to be the best benchmark for these portfolios, since they were all decided based on valuation metrics. I think that one makes the most sense, but I've also included the S&P here for context. So a $1,000 investment made in the S&P would have grown to $23.56, and there are two portfolios that outperformed the S&P over that time, the shareholder yield portfolio and the EBIT to EV portfolio. But then relative to the better benchmark, probably had almost all of them outperform, but the Buffett yield did underperform that as well. But somewhere between 4 out of 5 funds outperformed the benchmark. And finally, we have portfolio number 3, which is the Roth IRA. This is the only portfolio of the bunch where I've actually decided which stocks to go in it. So you can see my methodology here were Nathan's favorite businesses at the time. This also was not intended to be a coffee can portfolio. I put $61,794 into 22 different stocks back in July of 2021. Some of these were on the 7th, some on the 20th. So anyways, it was kind of miscellaneous days in July of 2021. And since then, I've had 0 transactions. So how would this portfolio have done? It's a little difficult to tell because, as you can see on my Schwab page here, reinvest, which stands for dividend reinvestment, is no. So I can see the performance of these stocks, but it does not consider dividends reinvested. So it's very difficult to tell what the actual performance would have been. So to solve that problem, and as I note here, I am going to use Portfolio Visualizer to approximate what the returns would have been had I been smart and turned drip on way back in 2021. So anyways, on to the portfolio itself and how it's done. This was the portfolio weighting in July of 2021. So here were the stocks, again, that I bought. You can see that some of them were exceptional winners. Like, for example, Constellation Software generated 42.7% annually, which is pretty amazing. But on the other end, you also had Adobe losing 13.8% annually. We had Baba, which is a terrible pick, down 10.4% annually. MSCI also down, Pool down, T Rowe down, Waters down. So you can see not all great picks here, but we did have some overall decent performers as well, some mediocre and some exceptional ones. The exceptional ones were AutoZone. Berkshire's been okay. Constellation, Costco's been great. Meta's been great, Progressive's been great, and Taiwan Semiconductors. Those, call it 6, have been responsible for the vast majority of the gains of this portfolio, which is why you can see the current weighting of the portfolio. The best performing stocks in a coffee can tend to go up a lot and become a large percentage of the portfolio. And since you're never trimming them, they become increasingly important, while the losing positions become decreasingly important. So you can see that Constellation Software is now 19% of the portfolio, whereas Adobe has not quite sold itself, but it's fallen to 1.9% of the portfolio. Alibaba down to 1.68%. So you can see that the weightings really start to change over time and start to favor the winning positions. So how has this portfolio performed? If we look at it here against the S&P 500, again, these are not actual results. These are as if I would have turned on dividend reinvestment. So I can't say that these would have been the perfect results, but it's an approximation as close as I can get to what it would have looked like. Also, full disclosure, I ran this both on 7/1 of 2021 as a starting date and 8/1 2021 as a start date. The 8/1 is what I chose because that's the one that looks the worst on relative performance. So just trying to be as fair and biased towards making myself look worse, I guess, instead of better. So anyways, but it is not actual results. Just want to be totally clear on that. But you can see that this portfolio was up 12.62% annually relative to 10.8% for the S&P 500. So we did get some outperformance relative to the market, which is good to see, especially considering there's been 0 transactions over that time. It's grown to 100,381 from 61,794. If that would have been invested in the S&P, it would have grown to 94,112. If you're not familiar with the coffee can investing methodology and you want to know more about it, I made a video a couple years ago explaining what it is and why I think it is one of the best investment strategies that you could possibly adopt. It's extremely flexible with individual stocks, with ETFs, with basically any kind of asset. So I think it's a great addition to your portfolio methodology. So if you're interested, click on this link right here or somewhere up here, and that will take you to that video. For all of you Patreon supporters, the Coffee Can scorecards for August 2025 are live, so you can access those now. I'll put a link in the description down below.